I heard down the grapevine that you were the only man on Wall Street that was happy with that news conference. Walk me through it.
That's so true. You're absolutely right, John. We saw the Fed come out and say they're obviously going to cut rates. They did cut rates, and it sounds like, though, they're not going to do 3 or 4 rate cuts. As we've always maintained, we think the ideal environment for the banks would be the rate cuts being 1 to 2 times by the end of the year. We have to remember next year is obviously an election year. Normally, the Fed does not like to fool around with rates in an election year. So if they cut later this year, 2 cuts, steepen the yield curve, lower deposit costs for the banks, that would be a positive backdrop for the bank stocks.
Gerard, you've been pushing this idea for a couple of months that we face the mid-cycle adjustment, the likes of Chairman Powell that he was discussing just yesterday, in the same vein as, say, the mid-90s. Do you still feel that that's this parallel that we need to be thinking a little bit more about for financials?
I think that's the way to look at it, John, because when you take a look at that mid-1990 time period, Greenspan obviously cut rates in July. He then cut them later in the year in 95. He stepped back in 96 because of the election year. The banks rallied throughout the 95 well into 1998 as Greenspan continued to cut. So this time the nominal levels of rates are clearly different, as you and I both know, but I do think a 1 to 2 rate cut by the end of this year is still viewed favorably for the banks, and I think investors will come around to that.
Gerard, here's the problem at the moment, though. If it's just 1 to 2 and it's not the easing cycle that we're priced for, there's many people in fixed income who just believe you won't be able to get a steeper curve if that's all you're going to deliver. So walk me through the areas of the yield curve that actually matter to profitability, and also the distinction between that and the areas of the yield curve that essentially will shape market perception, investor perception of what these stocks should be worth.
You really are bringing up a very good point here, because oftentimes the 2 to 10 yield curve is what everybody tends to focus on in the marketplace. However, when you sit down with the banks and you ask them what is the yield curve that affects you the most, it's the short end of the curve going out to the 5-year space. That's generally the part of the curve that the banks will benefit the most from. So if he cuts, the first immediate impact is you're going to start to see deposit costs come down, particularly for the deposits for the institutions and the high net worth customers. Obviously, the mom and pop depositors who didn't see much of a rate increase are not going to see their deposit costs cut. But if you were receiving all of the rate increases that the Fed was creating earlier, late last year, and before that, I think what you're going to see is those deposit costs come down. So as they come down, yield curve steepens. That's positive for the banks. They can reinvest at higher yields, and the funding of those reinvestments is lowered.
But Gerard, you know what the follow-up's going to be? The perception hasn't changed as yet. There are still so many people that believe, just in terms of investor bias, whatever it is, that the 10-year yield matters. And you and I can establish the fact that it doesn't matter in the way it has. And the influence of the yield curve on some of these financials has diminished over the last 10 years. But all of that has to push to the one side, Gerard, because still, people look at a 10-year yield, they'll see it 2%, they'll see it sub 2% right now, and they'll say, why do I want to own the banks? Gerard, do you seriously see the perception shift actually happening?
It will happen, John, when the banks can demonstrate that they can navigate through a flatter yield curve at the long end of the market, to your point, the 10-year. And how they're going to demonstrate that navigation, in our view, is through loan growth. If they can maintain 4 to 5% year-over-year loan growth, maintain positive operating leverage, then I think that's when investors will come around. The banks are hanging in there. Their performance this year versus the S&P is essentially neck and neck. If they start outperforming the S&P, that could bring more money in there. Most importantly will be what happens to deposit costs. I think you're going to see, John, that the second quarter and the third quarter of this year is the most amount of stress they're going to feel in the net interest margin. They'll start to get relief in the fourth quarter and into 2020.